fixed assets, as you can see here, and also intangible assets. And we'll talk about what the differences are and what that means. We'll also talk about different kinds of fixed assets. We'll talk about computing depreciation, making journal entries to dispose of fixed assets, and then also depletion, which is just a little bit different than depreciation. We'll talk about intangible assets, how to account for them, how depreciation is reported in the income statement and the balance sheet, and then we'll look at a ratio like we usually do. So the first thing we'll do is just talk about what is a fixed asset. A long-term, relatively permanent asset. And you can look at it, you can see it, you can touch it. It has physical form. Examples: machinery, building, land, property, plant, equipment, just anything that a business uses that has a long-term nature to help it run the business or benefit the business. So think of where you work or have worked, and just think of what kind of assets that your business has that are more permanent or more long-term. Obviously a building, if they own it, a lot of equipment, furniture, computers will last a few years, vehicles, things like that. So they exist physically, they're tangible, you can see it, owned and used by the company in normal operations, and not offered for sale as a part of your operations. You're not in the business of buying and selling fixed assets. Obviously some businesses are, but we're accounting for a business from the perspective of they're in business doing something, but they have to own physical assets as a part of running their business. If you look at, just think of a grocery store. Just think of the physical assets that exist at the grocery store, a building, go inside, all kinds of fixtures, all the shelving units and the refrigeration units and cash registers, and there's all kinds of assets that the business owns, but they're not offering those for sale, right? They're selling everything that's on the shelves. So we have to have assets as a part of running our business. We're not necessarily selling them. So obviously different kinds of businesses will have a lot of fixed assets than others. You can kind of just see some examples here. So classifying cost. Step one, it says, is the purchased item long-lived? And typically you think of more than a year. If the answer is no when we buy it, we just simply expense it. If the answer is yes, then the question is this used during normal operations? If the answer is yes, it's a fixed asset. If the answer is no, then possibly it's an investment that we intend to resell. So just some costs of acquiring a fixed asset. It's not necessarily just the negotiation of buying something. It's basically all the costs that we might incur to get a physical asset ready to use. For example, if we're going to build a building, maybe we would build a building from scratch and we'd work with a contractor to do that. We might incur a lot of cost to get that building ready to go. We'd have to hire an architect, engineers, insurance, interest if we borrow some money to pay for the construction. You can just see all kinds of examples there of costs that we might incur to get the asset ready to use. Same thing with the machinery. We can negotiate with a dealer to buy some machinery or equipment to get it ready for use in our business, and so there's one cost, but that would also include sales tax on the sale, maybe freight to have it delivered, maybe we have to hire an electrician or plumber to help us install it, recondition it potentially down the road, insurance, assembly. Just whatever cost it takes to get the asset ready to use is the amount that we will basically turn into fixed asset. And then same thing with land. There's several examples. Land is split between two categories, land and land improvements. So land itself is the purchase price, taxes we pay, permits, commissions, fees. You can see the list there. And that includes maybe removing unwanted building. Let's say salvage on that building from, if you buy a lot with an old building on it and you intend to knock that building down and put something else there, that land cost of getting it ready to use would include knocking down that old building, grading it, leveling it. Sometimes you have to pay for roadways, sewer, sidewalks, things like that. That might be a part of the purchase price. Land improvements are a little bit different. It's basically any improvement that's added to the land. So you can see trees and shrubs, or landscaping, fencing, lighting, parking lots. Now the difference between land and land improvements is that land, once we come up with that cost of land, we never depreciate land. But we do depreciate land improvements. I used to work in construction and property management, so the owner of the business, one thing he would always say, I don't understand investments, but I do understand real estate. And he said, because even if my building burns down, I still have a hole in the ground to build something on, right? So that's why we don't depreciate land. We assume it's always there. And if it's not there anymore, we've got bigger things to worry about. So land, we don't depreciate, but land improvements we do. They will not last forever, right? Landscaping at some point in time needs to be redone. Fences don't last forever. Parking lots don't last forever. Fences, things like that. So the cost of acquiring a fixed asset, unnecessary costs that do not increase the asset's usefulness are expensed. Okay, so I'll basically just think of it from the perspective of anything that I incur to get the asset ready to use, I capitalize, that becomes a cost of my asset. Okay, but certain costs after that are expensed as incurred. Okay, so vandalism, let's just say somebody vandalized a fence or a building, spray painted it, whatever. I might have some insurance proceeds to help me out, but just the cost of putting it all back together again is just simply going to be an expense. Mistakes in installation, theft, that's not insured. Maybe we have a deductible, that'd be an expense. Damage during packing, unpacking, installing. Any government fines because we didn't get the right permits. All those things would be a part of expenses. Okay, so expenditures that benefit only the current accounting period are called revenue expenditures. Just be aware of that term. Expenditures that improve the asset or extend its useful life would be a capital expenditure. Okay, and so there's a difference between the two. And so here is kind of just a little bit of a definition between the two. And make sure you understand these. This is a really easy thing for me to ask you about. Okay, so capital and revenue expenditures are revenue expenditure, normal and ordinary repairs and maintenance. Okay, just the things we have to incur, the expenses that we incur to keep our machinery, our asset, working in normal condition. For example, let's just say my business has a delivery van, and obviously that van will need regular oil changes. At some point in time, the tires will wear out. The brakes may wear out. Certain things are just going to wear and tear as we use the vehicle, and so there's just going to be some repair and maintenance cost to keep it up and running. Different than a capital expenditure where we might spend some money to, if the engine blows and we have to repair that, and we extend the useful life of our building or of our van now, that might be extraordinary repair or some kind of an improvement that will add to the additional useful life of the asset that we then capitalize it. So revenue expenditure benefits the current accounting period. Capital will benefit potentially future accounting periods. Okay, so ordinary maintenance repairs, you just simply debit the expense. So here we paid for a tune-up of a truck. Debit expense, credit cash. It says on May 4th, a $5,500 hydraulic lift was installed in our delivery truck so that we could more quickly and easily load and unload cargo. Different story, right? Now that hydraulic lift, we expect to be using that for quite a while, right? And that's going to add value to my truck. So we're debiting an asset and crediting cash. And then extraordinary repairs, it says the engine of a forklift that's near the end of its useful life is overhauled at a cost of $4,500, which means that we can now extend the useful life of this forklift. And so we are now going to, of course, benefit future periods. So we'll debit depreciation, accumulated depreciation on the forklift, and we'll credit cash. So here's just kind of a flow chart then for capital and revenue expenditures. And so let's just look at the green ones first. So cost benefits only a current period. It's a revenue expenditure. We just expensed as incurred. Ordinary repairs and maintenance is debit repairs and maintenance expense type of accounts. For benefits current and future periods, we call that a capital expenditure. There's two kinds here. Asset improvement, like the hydraulic lift added to the truck, add service value to the asset, debit fixed asset, and then we'll depreciate that over the useful life. For a capital expenditure that's an extraordinary repair, like our forklift engine rehaul or overhaul, extends the useful life of the asset. We then debit accumulated depreciation, and we revise both current and future depreciation. So we'd basically say now we've got the more useful life out of that forklift. We have to depreciate that extra cost of the overhaul over its useful life. How about if you lease a fixed asset? Two parties to a lease contract are as follows. The lessor is the person who owns the asset, so just kind of think lessor is the owner. That's how I remember it. Lessor is the owner, and the lessee is the person who's using it. Okay, so the lessee is paying the owner for the right to use the asset. Okay, that's one way to think about it. Okay, know those two terms. Know who the lessor is and the lessee is. You'll definitely be asked that on an assignment. Leasing fixed assets, a capital lease is accounted for as if the lessee has essentially purchased the asset. Okay, and if that's the case, then the asset's then amortized, written off as expense over the life of the capital lease. So you still depreciate it, but you call that amortization instead of depreciation, but it works the same way. A lease that's not classified as capital is considered to be an operating lease. Okay, and you treat that like an expense. Let me just give you an example of, I'll go back to the capital lease first. Let's just say you have a business and you're going to buy a delivery van, and just quite often leasing is just a way to finance a long-term asset. And let's just say instead of going to the bank and borrowing money and then using that borrowed money to buy the van from the dealer, you go to the dealer first and you talk to them and you agree on the van that you want, and they say, we could lease this van to you. And you say, sure, great. Well, you still end up potentially owning it at the end. So it's just a way to finance an asset. A lease, kind of works the same way as borrowing money. It's just that typically the owner and the user are negotiating with each other. So there's lots of different kinds of leases under capital leases, and we'll get to those at some point in the future. Okay, an operating lease is basically I get to use the asset for a little while, but ultimately I'm going to give it back to the owner. So let's just say our business is in a strip mall. We're just renting some space in a strip mall from whoever owns the strip mall. And let's just say we sign a 6-month lease, okay? And we're maybe a newer business. We're not quite sure if this is the right location for us, or if we might need to expand someday. So we're just going to sign a 6-month lease, and we do that, and that would just be an operating lease, and we would just treat every lease payment like an expense, because essentially we're just renting that space. If the lease ends and we leave the property, that property still belongs to the owner of the strip mall. Okay, if I went out and leased that van, when that lease ends, I own the van. That's a capital lease. So there's a difference between the two. So know those two differences. That will definitely come up on a test or a quiz. So next we'll actually compute depreciation. So over time, fixed assets lose their ability to provide service. Their usefulness declines. Wear and tear, obsolescence, there's all kinds of reasons. And so we have to match the use of an asset um, to expense every year we use the asset. So if I buy a delivery van and I expect that that van will last for 5 years, I would record some expense every year for the next 5 years to depreciate the cost of that van over its useful life. And that's depreciation. Basically matching use through expense to every accounting period we use the asset. So accounting for depreciation can be caused, of course, depreciation itself can be caused by just physical wear and tear, or functional depreciation, which is more obsolescence. Basically, maybe new technology comes along, making one asset obsolete, or basically customer needs change. They don't need this, we don't need the asset anymore, whatever it is. So a couple things to keep in mind about depreciation. Depreciation does not measure a decline in market value of a fixed asset. It has nothing to do with that. It's completely separate than what if the true a market value of an asset is. And the bottom one, depreciation does not provide cash to replace fixed assets as they wear out. If you need to set aside cash to pay for a new fixed asset, that's a completely separate that's something completely separate than depreciation. Factors in computing depreciation: basically, what's the cost of the asset, how long do we expect to use it, and what will the residual value of the asset be when we're done using it. The expected useful life of a fixed asset is basically how often we expect to be able to use it. Okay. Residual value is what it will be worth when we're done with it. Can we sell it or dispose of it and get a little bit of money back? So factors in computing depreciation: of course, the cost minus residual value is how much I actually get to depreciate, and then I allocate that cost over useful life by treating that like depreciation expense. So whatever that depreciable cost is, I allocate that cost to every period I expect to use the asset and treat that like expense. So factors in computing depreciation, you can just see the different methods: straight line, units of output, and declining balance methods, and there's a few other ones. You can just see that straight line is by far the most popular. So the straight line method provides for the same amount of depreciation expense for each year of the asset's useful life. So once I come up with the number per year, it stays the same every year. It never changes. And that formula is very easy. It's not too hard to calculate. So make sure you understand this formula. Annual depreciation is cost minus residual value divided by useful life. Okay, that's straight line depreciation. So if I get a number, it's that same number every year until the asset is done. I'm done using it. So a very easy example here. I have an asset with a $24,000 cost, a useful life of 5 years. I expect a residual value of $2,000 when I'm done with it. And so it says 24,000 minus 2,000 is 22,000 divided by 5 years is 4,400 per year. So for the next 5 years, I'll record $4,400 worth of depreciation. It says the preceding equipment was purchased and placed into service on October 1. The depreciation for the first year, we'd prorate that. Basically, we're going to use it for 3 months of the first year. So let's just take that annual number of 4,400 and multiply it by 3 over 12. The straight line method can be determined by dividing 100% by the number of years. And so a 5-year asset would simply be 100% divided by 5 is 20%. An 8-year asset would be 100 divided by 8, which is 12.5. 10 years, 100 divided by 10, which is 10%, and so on. That's just an easy way to get to a percent per year to depreciate. Next is units of production. And what units of production is trying to do is match depreciation expense against use. And so if we have some machinery that the use of it may vary between years, we're basically saying if that's the case, let's record depreciation based on whatever unit of output we can measure. And so if we use this asset more in one year than the next, the more we use it, the more depreciation will be recorded, and vice versa if we don't use it as much. And so very similar formula as straight line. It's still cost minus residual, only now we divide by total units of production. Whatever amount of units we expect to produce with this asset is what we'll divide it by. And so depreciation expense then is the value of depreciation per unit, that's what this first formula gives me, times however many units I produced or measured that particular accounting period. So we'll go back to the same numbers that we did with straight line, only now we're, instead of saying this asset's good for 5 years, we're basically saying that we expect to be able to use this asset for $2,100. And when we're done with that, the asset will be done. 2,100 hours. At that point in time, the asset doesn't have useful value to us anymore. We'll dispose of it and get $2,000. At least that's what we're thinking for now. And so step 1, determine the depreciation per hour. And I might have to put that in PowerPoint mode to get that to work here. Okay, so basically cost minus residual value divided by total units, I get 220 per hour. Okay, 220 per hour under 10,000 hours. Okay, compute depreciation expense. So in year 1, if I use this asset for 2,100 hours, my depreciation expense in this first year is $4,620. So basically, I guess I might have misstated in the previous example, we expect this asset to be good for 10,000 hours. In the first year, we're going to use it for 2,100 hours. And so in the first year, I get expense of $4,620. Okay, let me get out of that mode. So double declining balance then is basically taking, it says provides a declining periodic expense over the expected useful life. It's what they call an accelerated method. You take a ladder depreciation early on in the asset's life, but not as much later on towards the end of the useful life of the asset. So there's 3 steps to compute this method. Basically, just come up with the straight line percent. Okay. Once you have the straight line percent, double it. And then compute the depreciation expense by multiplying that from the book value of the asset. So we'll look at an example here. And so very easy to compute the percent. You basically just say 1 divided by the useful years. So if we have a 5-year asset, if you just take 1 divided by 5, you get 20%. Then double that, you get 40%. So let's just say it was a 10-year asset. You'd take 1 divided by 10, you'd get 10%. Double that, you get 20%. Okay, so using the double declining balance method, a 5-year asset results in a 40% rate. For the first year, the book value of the equipment had a cost of $24,000. So still going back to our same equipment example. So there's one key difference between double declining and straight line and units of output, and that is that I don't take into account salvage value at first. Okay, so the goal here is to take as much depreciation as I possibly can early on. Okay, so I'm taking that 40% rate, not times 22,000, which was 24,000, minus 2,000 residual. Instead, I'm taking 24,000 times 40%, and I'll kind of think about that 2,000 in the background because towards the end of the useful life, I'll have to take that into account. So for example, double declining balance, depreciation for the 5-year equipment is below. So this is going back to my $24,000 equipment. So in year one, I take 24,000 times 40%, and I get a really big number, 9,600. And so my book value at the end of year one is 24,000 minus 9,600. I get 14,400. Then in year two, I just basically go, okay, 14,400 times 40%, 5,760, and so on. Just keep following that pattern until I get down to the fifth year, and I cannot depreciate past residual value. So basically in that last year, we just have to take into account what's my residual value, knowing that I cannot depreciate more than that. Okay, so here is my total cost of $3,110, and I just know that between year and 4, the value has to be year 2000 at the end, so here I am. Okay, and so what this is doing is basically just saying that we force that fifth year depreciation to get down to the desired ending book value. Then it says that the preceding equipment was purchased and placed into service mid-year, basically October 1, that's October, November, December, for 3 months. We just take that first year of depreciation, which we computed at 9,600, and just take a third of that for the first year. Then the second year would be 8,640, which is basically the balance of it. Okay, you can see 24,000 minus 2,400 taken in the first year, then you get 8,640. So it changes a little bit if you place an asset in its life mid-year. So double declining balance method provides a higher depreciation in the first year, followed by declining amounts thereafter. So we call it accelerated method. And so you can see here we've got a nice little summary of all 3 methods: straight line, units of output, and double declining. Okay, so just a nice little one-stop shop for a summary of each. And then just comparing the methods, ultimately we're depreciating $22,000 for all 3. It's just how much we recognize in each year is very different. You know, straight lines is the same every year. Units of output is completely based on hours used. Double declining just takes a whole lot right away and not very much at the end. Depreciation for federal income tax, a little bit different. We call it the MACR system. Stands for Modified Accelerated Cost Recovery. And the reason for that is, of course, the tax code is kind of geared towards getting people and businesses to do certain things. And so quite often the tax code says that you can accelerate depreciation because that will stimulate the economy by having businesses buy expensive things, you know, machinery, equipment, and so on, knowing that they can depreciate a lot of that right away and get an immediate tax benefit by having a whole bunch of depreciation expense. So MACR specifies 8 classes of useful life and depreciation rates for 8 classes of assets. The 2 most common are 5-year classes, which is automobiles and light-duty trucks, and 7-year, which is for machinery and equipment. So kind of based on the asset type, so you buy an asset, and then basically based on what that asset is, it falls into 8 categories. And once it's in that category, then the MACR system defines how many years of useful life you can use to depreciate the asset. So for a 5-year asset, here's what you would do. You take these rates. Okay, so you're still taking a lot early on and not as much later on. Okay, so next then is revisions of depreciation estimates. So just know that there are a lot of estimates in accounting, and you know, obviously once we begin to use an asset, we estimate 2 big things. We know the cost. We've got that figured out. We've got source documents to say, here's what the asset cost me. But here is, I'm guessing 2 things. I'm guessing useful life, and I'm guessing useful life in terms of either time or units of output, and I'm also guessing a residual value. Okay, and we use the best information we have when we buy the asset. But as we begin to use the asset, we may realize that, oh, we made not the best decision, or we're aware of better information now, and we believe this asset may last longer, may last less, um, may have a different residual value than we originally thought. And so here's an example then of we buy a machine. The initial cost is $140. We expected a useful life of 5 years, and we expect the residual value to be 10,000. So basically, based on that, we're straight lining this at 26,000 a year for 5 years. We'll depreciate 130,000 away. We'll dispose of it for 10,000 in year 5. That's what we think is going to happen. At the end of 14, so basically 2 years worth of depreciation has been recorded, all of 13, all of 14, right? Because we purchased this on January 1 of 13. So 2 years worth of depreciation goes by. So at the end of 14, book value is 88,000. So keep in mind what the book value means. Book value is simply cost minus depreciation taken. That's my book value. So the book value after 2 years is 88,000. And so we begin 2015, we start doing our thing, and we're using the equipment, and we become aware of some different information. Okay, so we become aware of information that the useful life is 8 years instead of 3. So originally we thought this asset would be run for 5 years. 2 years have gone by, so at this point we think there's 3 years left, until we become aware of the fact that no, really, we think this asset will last longer. So it's going to be 8 years, and that the residual value is going to be 8,000 at the end of that time period instead of 10,000. And so based on that new information, we go ahead and we revise our depreciation expense. And so original book value is 88,000 after 2 years. We subtract our new revised residual, we get $80,000 worth of cost then that should be depreciated between now and 8 years from now. And then we just take 88 minus 8 divided by 8, and we get 10,000. So now I'm going to record depreciation at the rate of 10,000 per year, which is obviously very different than what we did for the first 2 years. And that's okay. A lot of estimates in accounting. When we become aware of a better estimate, we go ahead and we make that change and move forward. So this is just kind of a picture then of how depreciation was recognized for this asset. A lot was taken the first 2 years based on a 5-year life, but then we realized this asset is going to last longer than that, and so depreciation went down. Okay, we have not done journal entries yet, so let's move on to journal entries. And so it says here, equipment acquired at a cost of $25,000 is fully depreciated on December 31, 2013. On February 14, 2014, we discard it. Okay. So basically what we're doing is we're writing off equipment that's been discarded. And you can see here, we depreciated it all away. There's no residual value to think about. And so we make this entry. Now, what they haven't shown us is the entry to actually just record depreciation. When I record depreciation, I debit depreciation expense, and I credit the account called accumulated depreciation. So debit expense, credit accumulated depreciation. Accumulated depreciation is a contra account. And whenever you hear the word contra, I want you to think opposite balance. Assets we know have a debit balance, and so when I record a contra asset account, it would have a credit balance. So every time I record depreciation, I debit depreciation expense, and I credit accumulated depreciation. Okay, so now we're at the point where we've depreciated an asset away over its useful life, whatever that was. The cost is $25,000. So after its useful life, we've also recorded $25,000 worth of depreciation expense, and now we're going to dispose of the asset. Okay, and so basically, if I'm going to dispose of an asset, I have to undo the asset cost, and I have to undo all the depreciation taken. So that's what this asset's or that's what this entry is doing, is I credit equipment because it's gone away, it's disposed of, and I remove all the depreciation taken because, again, that's being disposed of, that's going away too. So discarding fixed assets, it says equipment costing us $6,000 with no residual values depreciated at an annual rate of 10%. After December 31 of 13, adjusting entry, accumulated depreciation, equipment has a balance of $4,650, and on March 24th, the asset's removed from service and discarded. So we can just realize that an asset has no longer useful, but we have not completely depreciated it all away. And so we make this entry, discarding of a fixed asset. So what we have to do, first of all, before we discard it, is catch depreciation up to the date of disposal. And I do that by basically saying depreciation is $600 a year. And so between January 1 and the end of March, when I dispose it, I have to make an entry to catch up depreciation, get it current. I record depreciation expense by debiting it, and I credit accumulated depreciation. So now my depreciation is up to date before I dispose of it, and then I dispose of the asset. Okay, so the cost was $6,000, so I credit equipment for its cost, and then I take away all the depreciation taken. I debit the accumulated depreciation account, because at this point in time, at the point of disposal, I have taken $4,800 worth of depreciation expense. And then the difference, the $1,200, is simply a loss. Basically, when I recorded the original depreciation estimate, I just didn't make a good estimate. I was off a little bit. The asset did not last as long as I thought it would, so therefore I have to just basically catch that all up now, and the only way I can do that is to debit the loss on equipment disposal to get it caught up. So when an asset is disposed, we credit the asset cost, we debit the accumulated depreciation taken, and whatever difference there is going to be a loss. So selling fixed assets. So what if I decide to actually sell a fixed asset? And this is equipment purchased at a cost of $10,000, had no residual value, depreciated straight line over 10% per year. The equipment is sold for cash on October 12th on the 8th year of its issue. Balance of depreciation as of the preceding December 31st was $7,000. So the first thing we do is we go, okay, depreciation was $7,000. I have to get depreciation current from December 31 to October 12, get that up to date, and then I can record the sale. So the first thing that I'll do is basically just say, okay, we've used this asset for 9 months. We were depreciating it, it says $10,000 original cost, times 9/12 of a year, times 10% for a full year. That gives me $750. So now depreciation's up to date. And then I go and I sell it. And what I have to do is compare book value of what I'm selling to basically the cash that I'm receiving. So after the depreciation is recorded, book value of the asset is $2,250, cost of $10,000, minus depreciation taken of $7,750. That gives me a $2,250 book value. Okay. And so I'm going to sell the asset exactly for book value. Okay, so I'm going to receive a check for $2,250. I'll debit cash for $2,250. I'm going to credit equipment for the original cost, and then I debit accumulated depreciation for the amount of depreciation taken. So there's no gain or loss. I received in value in cash exactly what I gave up in book value. So let's just say that changes a bit, and let's just say instead of receiving $2,250 in cash, what if I receive only $1,000 in cash? So I'll debit cash for $1,000. I'll debit accumulated depreciation for $7,750, the same as the previous entry. I still credited equipment for the $10,000 cost. Now the difference is I debit loss on equipment of $1,250 because I gave up book value of $2,250. In exchange, I received only $1,000 in cash. So to make the entry balance, I have to debit loss. Well, what if I received more than book value? So in this example, let's flip it around and say, okay, I received $2,800 in cash, and the book value I'm giving up is $2,250. So now I have a gain on the sale. So I received more in cash than what my book value was. So it's a difference of $550. Remember that book value does not signify market value. They're very different. Book value is an accounting thing. It's just simply what we end up with after trying to match cost of the asset to its useful life. And we're just taking cost, allocating it to expense through depreciation, and at some point, that just leaves a book value left over. And that book value has absolutely nothing to do with the true market value of the asset. So it's very common to have a gain or a loss. Okay, next is depletion. It works very much the same way as depreciation, but it really belongs more to natural resources. So the transferring the cost of natural resources to expense is called depletion. So first of all, you kind of really think of it as units of output. And so what you do is you come up with a depletion rate, and you do that by taking the cost of your resource, whatever the resource is that you're depleting, and you divide that by the estimated total units of your resource. That gives you then depletion expense, and you multiply your depletion rate per unit of resource times the quantity of resource extracted. So this could be a mineral in the ground, barrels of oil, trees in a forest, any natural resource that you can measure the total amount of, and then measure the extraction or removal of. So if a company paid $400,000 for the mining rights to a mineral deposit, we estimate there's 1 million tons of ore, and during the year we mined 90,000 tons, what would we record for depletion? Depletion expense is computed as follows. The depletion rate is the cost of the resource, $400,000, divided by the tons of the resource. That gives me 40 cents per ton. So if I remove 90,000 tons, I multiply that by 40 cents, I get $36,000. So we make an adjusting entry then, just like we do for depreciation, and we're going to debit depletion expense and credit accumulated depreciation. So it works very much the same way as actual depreciation, only that we call it depletion. Okay, next we'll talk about intangible assets. Intangible assets. So they lack a physical substance. They're really just evidenced by a piece of paper, typically. So think of a patent that you would file on an invention, a copyright on a slogan, trademark on a company logo, or goodwill are long-lived assets used in the operation of business and not held for sale, but they have no physical form. We call them intangibles. Accounting for intangibles is very similar to fixed assets. However, a couple of issues are determining the initial cost of the intangible asset and then determining the amortization, which is the amount of cost transferred to expense. So amortization relates to intangible assets, depletion for natural resources, and depreciation for physical assets. So make sure you know the difference between the three terminology. A patent, excuse me, there's different kinds of intangibles. A patent is an exclusive right granted by the government to produce or sell a good with some unique feature. Okay, so quite often you hear of somebody coming up with an idea and they patent that idea to protect their idea from somebody else being able to steal it from them. Obviously they have value. At the beginning of the fiscal year, a business acquires patent rights for $100,000. The patent's remaining useful life is estimated at 5 years, and we make an entry. So it's not unusual for one company to buy the patent rights from another company or from an individual. Somebody came up with an idea, and a company has the ability to use that idea or produce a product based on that idea, and so they buy the rights. Very common. And so when you buy the rights, obviously it's kind of like buying an asset, or I should say a physical asset. It's just that you have a piece of paper that says, now I have the right to do something. So I'm going to debit. When I buy the asset, I would debit patent and credit cash for $100,000, and I'm just simply going to straight line it. Okay, so I'm basically saying I expect to be able to use this patent for 5 years. That's an estimate, of course, and if it's based on technology, that might be a long time. We don't know, but we'll debit then amortization expense, and then we credit patents. And notice that we did not credit accumulated amortization patent. We credited the patent account itself. Because a patent does not exist physically, it's acceptable to credit the asset. The approach is different from physical assets, which require the use of the contra account, the accumulated depreciation or the accumulated depletion accounts. So copyrights and trademarks, exclusive right granted by the federal government to publish and sell literary, artistic, or musical works is called a copyright. Okay, and they last a long time, 70 years beyond the author's death. A trademark is a unique name, term, symbol used to identify a business. Most businesses identify themselves with a trademark in their advertising. They can be registered for 10 years and renewed for 10-year periods thereafter. They're continuously renewable. I mean, it's pretty rare that you wouldn't be able to renew it. So think of the Nike swoosh or the Under Armour logo. The list goes on of trademarks that companies have registered with the government saying this logo represents my business. Goodwill refers to an intangible asset of a business that's created from such favorable factors as location, product quality, reputation, managerial skill, things that a business has just accumulated over time based on being run well. Goodwill, generally accepted accounting principles permit goodwill to be recorded in the accounts only if it has been determined through a transaction. You can't just debit goodwill just because you feel like it. It only happens if you buy another business and you attempt to measure that value of that goodwill. So let's just say we do have goodwill on the books. Okay, so basically we bought another business and now we have some goodwill. You can typically measure goodwill when you go out and buy another business. So we've got goodwill in the books. And what you have to do then, once you have goodwill, is you do an annual impairment test. And you determine if this goodwill still has value. There's lots of ways to do that, and how you do that is above and beyond the scope of this class. We get into that in intermediate accounting. So for those of you who move on to intermediate, you'll learn it then. But basically, we're just going to be told that goodwill has lost value. And so if we're told that goodwill has lost value, we're going to debit the loss and we credit the goodwill asset itself. Okay, so it's a very simple entry. So intangible asset disclosure, basically this is just saying for a 500 firm survey that was taken, how many different kinds of firms had what kind of intangible assets on the books. Almost all had goodwill, right? A lot had trademarks, brand names, copyrights, customer lists is another one. So there's all kinds of examples of intangibles that are on the books of companies. So here's just a nice little summary of the 4 major categories of intangible assets, a description of each one, what we do each period to record it, and then what the expense looks like. Okay, so it's a good little summary of the 4 types. So make sure you know that. Very easy for me to ask you questions on a test or quiz about those. Okay, so next let's look at how intangibles are, depreciation expense I should say, is recorded on the financial statements along with intangibles. So here is a balance sheet for a company called Morning Joe. You can see here that Morning Joe has some property, plant, and equipment. There's some land, some buildings, some depreciation, office equipment, so on. So you can just see that for every asset, you had every asset except land, I should say, for the property, plant, and equipment assets. Besides land, for the building and the office equipment, you have cost minus depreciation, which gets you to book value. For the intangibles, there is no depreciation or depletion or anything like that. It's just simply the value of the intangible asset. Okay, so just be aware of the disclosure, what that looks like on the balance sheet. Intangible assets are reported in the balance sheet in a separate section following fixed assets. The balance of each intangible asset should be disclosed net of amortization. So we don't show the amortization, we just show the balance net of amortization. And the cost and related accumulated depletion of mineral rights is normally shown as a part of fixed assets also. Okay, finally a few ratios to look at and think about. For this one, let's just think about fixed asset turnover ratio. Measures the revenue generating efficiency of fixed assets, is the fixed asset turnover. So basically, how effective or how efficient are we at using fixed assets to earn revenue? That's what this ratio is trying to figure out. So we just take our net sales number, divide it by the average book value of fixed assets, we get a number. So how good are we at using a fixed asset to earn sales? That's basically what we're trying to figure out. Okay, there is an appendix to this also. I just want to talk a little bit about exchanging similar fixed assets. It's not unusual to have a vehicle, a delivery van of some sort, and we use it, drive it for a few years, and then we go and trade it in for a new one. Obviously a very common thing for a business or for us as individuals to do. So old equipment is often traded for new, having a similar use. In such cases, the seller allows the buyer a trade-in allowance for the old equipment that's been traded in. The remaining balance, whatever's left over, is either paid in cash or recorded as a liability. It's normally called the boot. Okay, so the cash is the boot. And so just an example of that, we're going to exchange similar, and we might end up with a gain or loss on the exchange, of course. And so what we do is, you can see here, we're taking some information and turning it into a journal entry. It says the price or fair market value of the new equipment, plus the trade-in allowance is $3,900. And then we compare that to what we're giving up, the old stuff that we're trading in. And that cost was $4,000. The depreciation taken was $3,200. The book value is $8,000. Okay, so basically, what we have to do is undo the old asset that we're giving up. So we credit cost of the old equipment, $4,000. We debit accumulated depreciation of the equipment given up, the $3,200. We then record the new equipment. We debit it for the price, debit cost of $5,000. And then we have to give up cash, $3,900. And so we're going to pay cash at $3,900, credit cash for $3,900, and then we either have a gain or a loss. In this example, we had a gain of $300, so that gain or loss makes a balance. And the next slide shows us where that gain calculation came from. So the fair value of the new equipment is $5,000. The book value of what we gave up is $800. We paid cash as $3,900. So basically, we gained value of $5,000, but gave up value of $4,700. So therefore, we have a gain of $300. And of course, the same thing could happen as a loss. We could do the same type of transaction and end up with a loss. And so it's kind of just taking the same information and this time just changing the numbers a little bit, mostly in terms of the cash paid. So we're going to pay more cash this time, which means now we have a loss in the equipment. So just be aware of an exchange. Just think of it as trading in old equipment for similar new equipment, and usually that involves writing a check. And just always keep in mind you're comparing book value of what you give up to fair value of what you receive, and you'll have a difference that could end up being a gain or a loss. And that's it.